Good morning, this is Dr. Finance, broadcasting live for your essential dose of macro reality on Dr. Finance Daily. Look around the trading floor this morning. We are seeing a market exhibiting what I can only describe as schizophrenic behavior, a perfect microcosm of the anxiety gripping global capital right now. The headline is clear. Disinflationary signals are fighting tooth and nail against persistent, structural inflationary pressures, and the indices are utterly confused about which way to pivot. We are seeing the NASDAQ, the tech monolith, showing some modest strength today, buoyed by the giants like NVIDIA, while the small cap barometer, the IWM, continues to bleed out under the weight of higher for longer narratives. SPY is dragging slightly lower, telling us that breadth is a fantasy, not a reality. This isn't about minor fluctuations. This is about the structural integrity of the rally. Are we pricing in a soft landing, or are we simply running on fumes fueled by speculation about a policy pivot that Chairman Powell is not even remotely hinting at? My thesis remains unchanged. The path of least resistance for policy is up and staying there. And that reality is starting to chew through the froth in risk assets. We need to address this dissonance immediately. Let's dissect the tape. It's a study in divergence this morning. The S&P 500 tracking ETF, SPY, is sitting at $678.87, down 0.27%. A clear sign of risk aversion creeping back into the broad market as investors reassess Q3 earnings prospects under sustained rate pressure. Conversely, QQQ, our tech bellwether, manages a thin 0.20% gain, settling at $611.75. That resilience is being propped up entirely by the AI narrative, specifically NVIDIA climbing 0.81% to $177.72. Be very cautious. This narrowness is a red flag. It means the flow of funds is hyperspecific, not indicative of overall market health. The Russell 2000, IWM, is the canary in the coal mine today, plunging 0.47% to $249.90. Small caps cannot digest these yield levels. They represent true economic exposure, and they are screaming that the cost of capital is prohibitive for genuine growth right now. On the individual names that matter, Tesla is showing a commendable 3.07% surge to $489.88. Interesting bounce there, perhaps shorts covering, or a technical rebound, but the EV macro environment remains fiercely competitive and margin sensitive. Apple and Microsoft manage slight gains, confirming the mega-cap fortress trade, investors defaulting to the names they perceive as too big to fail in a volatile macro backdrop. Volatility, the VIX, is thankfully cooling off slightly, down 1.94% to 16.16. That's a temporary suppression of fear. Do not confuse a low VIX print with market safety. It just means the derivatives market is temporarily complacent about tomorrow's moves. We need to watch that closely. Now, let's talk about the engine room of global pricing, the fixed income market. This is where the real action, the real gravity, resides. The 10-year Treasury yield, the benchmark for everything from mortgages to corporate debt valuation, is currently pegged at 4.15%. Crucially, it's down 0.79% this session. We are seeing a flight to quality, even if it's tentative. Why the dip? Because the stock market is blinking, and when equity risk perception increases, the reflexive trade is back into duration. But drive. Finance wants you to look past today's noise. The structural issue is the yield curve. We are still profoundly inverted. The spread between the 2-year and the 10-year remains a screaming warning signal of impending economic contraction, or at best, significant deceleration. We are not seeing the curve normalize because the market still doesn't believe the Fed is done tightening. If the Fed were close to cutting rates, we would see the 10-year yield collapsing rapidly, not hovering stubbornly above 4%. This stubbornness in real yields tells you that inflation expectations, while perhaps moderated from peak hysteria, are still priced significantly higher than the Fed's 2% target. Every time the bond market tries to rally hard, the market steps in and says, wait, inflation is sticky, Powell is hawkish. The 4.15% yield is a critical psychological level. If we break sustainably below 4.00% on the 10-year, then we can start discussing a genuine, risk-on, environment supported by looser financial conditions. Until then, we are trading in a high-rate purgatory. The spotlight remains fixed firmly on Washington and Frankfurt. The narrative is simple. Data dependence, delivered with a side of perpetual skepticism. The Federal Reserve has been crystal clear. They have more work to do. We are hearing a consistent drumbeat from every Fed governor wheeled out for interviews. Inflation is too high, the labor market is too tight, and rate cuts are not on the immediate horizon, despite what the market prices in for Q1 next year. Dr. Finance views this as a commitment device. The Fed must maintain this hawkish posture to anchor inflation expectations. If they signal any weakness now, inflation expectations re-accelerate, and they will be forced to hike even higher later, a policy failure they desperately seek to avoid. Expect the economic data releases this week, especially employment figures and CPI proxies, to be treated not as historical reports, but as direct communications to the FOMC. A strong jobs number right now is bad news for the stock market, because it necessitates sustained restrictive policy. Over in Europe, the ECB faces a more complex trade-off. They are dealing with a more pronounced energy shock aftermath and weaker domestic growth indicators. However, core inflation remains stubbornly elevated. They are constrained by the Fed's actions. If the ECB eases too early, the euro collapses, importing inflation back via weaker currency translation, negating domestic efforts. They will likely follow the Fed's lead, albeit with a slight lag, maintaining a restrictive stance until evidence of severe economic contraction emerges. Don't expect fireworks from the ECB. Expect cautious, grudging tightening. The commodity complex is flashing signals that contradict the equity market's optimism about a smooth economic glide path. Look at gold. GC=F is up 1.01%, sitting robustly at $4,347.90. Gold is performing its textbook role as a hedge against currency debasement and macro uncertainty. It's not just reacting to bond yields, it's reacting to geopolitical instability and the structural integrity of sovereign debt. A strong rally in gold alongside a slightly weaker dollar, DXY, NYB up 0.33% to 98.55, suggests investors are hedging against systemic instability, not just seeking yield. Now, oil. CL=F is up a healthy 1.47% to $56.08. This price level is significant. It suggests that the supply side, OPEC plus compliance and geopolitical risk premium, is overriding bearish demand forecasts related to slowing manufacturing. If oil firms up here, it directly translates into higher input costs for every sector outside of pure software. It's a direct threat to the corporate margin recovery narrative that the bulls are clinging to. Copper, the industrial barometer, remains subdued relative to its historical correlation with strong global growth. This disparity, strong gold, strong oil, but subdued industrial metal, tells Dr. Finance we're in a stagflationary environment, not a Goldilocks growth scenario. Demand is weakening structurally, but supply constraints and geopolitical friction are keeping energy and hedges high. Which sector is showing true conviction amidst this noise? It's the fortifications. The clear winner today, and for the structural shift we are undergoing, is technology, specifically the large-cap software, cloud infrastructure providers. We noted AAPL, MSFT, and NVIDIA holding the line. Why? Because these companies are the primary beneficiaries of forced digitalization and efficiency drives across the corporate landscape. When capital is expensive, companies don't invest in speculative expansion, they invest in efficiency. And efficiency comes via cloud migration, AI optimization, and better data processing, all Microsoft, Google, and NVIDIA domains. They have the balance sheets to withstand higher interest rates, they generate massive free cash flow, and their pricing power, while tested, remains superior to legacy manufacturing or highly leveraged industries. Be cautious of the mid-cap tech names reliant on venture funding cycles. That liquidity tap is drying up. Focus on the titans that are becoming utility providers for the global economy. They are the only ones truly insulated from the current yield shock. A necessary, though brief, look at the non-sovereign assets. Bitcoin and Ethereum are taking a beating, down 1.09% and 1.36% respectively. BTC is languishing around $86,889. This is textbook de-risking. When volatility spikes and real yields rise, speculative, non-yielding assets are the first to be jettisoned. Crypto is not acting as the inflation hedge proponents hoped for, it is acting as a high beta risk asset, correlating strongly with the NASDAQ's excesses. Support for Bitcoin rests heavily around the $85,000 psychological floor. A definitive break below that signals that the market is repricing the entire crypto complex lower, targeting the next structural support zone nearer $78,000. For now, it's a low-conviction asset in a high-conviction, high-rate environment. Stay away unless you are trading the technical rebound, not the macro thesis. Strategy must be defensive, prioritizing capital preservation over aggressive directional bets. 1. Monitor yields. The primary focus must be the 10-year Treasury. If it breaks decisively below 4.10%, we initiate small, tactical long positions in cyclicals that have been oversold due to rate fears, like basic materials. 2. Fade the momentum. Do not chase the NVIDIA or TSLA intraday moves unless they break significant resistance levels. Today's equity strength is likely fueled by option positioning and forced portfolio rebalancing, not fundamental news flow. 3. Watch the dollar. The dollar index, DXY, is showing signs of renewed strength, which is pressuring emerging markets and large multinationals reporting foreign revenues. If the DXY pushes past 99.00, expect global equities to buckle under the currency headwind. We are operating in a regime where duration risk is paramount. Every cash flow projected 10 years out must now be discounted at a substantially higher rate. This structural repricing will not resolve itself quickly. This market is currently engaged in a psychological battle between what investors want to happen, a Fed pivot, falling rates, smooth landing, and what the data is telling him is happening, sticky inflation, tight labor, and relentless policy restriction. Dr. Finance always stresses that macro reality trumps market consensus. And the macro reality is that financial conditions are tightening globally, liquidity is being withdrawn, and that process is inherently deflationary for asset prices, even if it's inflationary for necessities like energy and food. Do not get lured into believing the recent minor dip in volatility signifies the end of the grind. It is merely a brief respite before the next data point forces another reckoning on valuation. Be disciplined, be selective, and hedge your portfolio against persistent uncertainty. That's it for your analysis this morning. Stay alert, stay rational. I am Dr. Finance. We'll see you tomorrow.